their import and export price indexes. So import prices rose 0.42% month over month, which was up 3.5% year over year. That's up a little bit from last month in the year over year, obviously 0.42% month over month, largely due to rising natural gas prices, not really an increase in demand. And really, the one that we want to focus on here is U.S. export prices. U.S. export prices, they crashed. They collapsed by 2.64% month over month. So that was just December from November. And export prices have been down consistently, as have import prices, since June. So in the global trade arena, especially where it intersects with the United States and U.S. demand, prices have been falling pretty steadily, especially export prices and import prices up until this month or December. Prices have been falling since June. There we see this again, a sharp response in price pressures based on a macroeconomic circumstance that has nothing to do with the Fed.
Aren't the declining consumer prices a good thing? Does not it represent dropping inflation pressure that has worsened the citizens' lives? Well, yes, when prices of products start to decline, usually it's a good thing for the consumers. They get to buy products at lower prices, which helps them save some money in surplus. However, the stakes are now different because the dropping prices are pointing toward the worst market breakdown. According to the latest Consumer Price Index data, import and export prices and the market turnout, one thing becomes quite clear: the markets are prepared for a downfall. But the question here is, why is this the case? Why is this good news actually bad? Well, the answer lies in the question. However, it's not that easy to decode. That's why we have brought Jeffrey Snider from Atlas Financial Advisors, who has some hidden insights to share with you. Watch the video until the very end because we don't want you to miss important points that can save you from the market breakdown. Let's get started by knowing the apparent good news. Recently, the CPI, or the Consumer Price Index report, has come out that shows the declining consumer prices. It should be noted that the report manifests the already declining consumer prices from the last 3 to 4 months. That's where the consumers feel it's something they should be happy about. Since the prices are coming down, it's perhaps the deflation everyone was waiting for. Unlike inflation, where prices continue to rise, in deflation, the prices come down and purchasing power of the money increases. However, that's not the underlying reality. Jeffrey Snider said that this is not deflation, rather, it's disinflation. In other words, prices are not going down, instead, they are pivoting around a price. Instead of price fluctuation and price increase, the markets will see price stagnation, Jeffrey Snider said. But what will it bring? Stay tuned to know about that. But before we tell you why prices will stay stagnant, you must know the precarious situation of the export and import prices. A country's economy booms when it has to pay little for imported products. At the same time, the economy strengthens when the amount of capital a country is being paid for exports increases. In both these cases, a country can save the difference in the import and export bills. But one factor everyone misses is this: it's the prices of the products, not the quantity, that decides what will happen to the economy. In other words, a country won't earn much when it sells more products. Rather, profit means a lot when the price of every individual product is high. But the reports say otherwise. For the U.S., the import price index has increased by 0.42% on the month-over-month scale. This makes a 3.5% increase in the year-over-year scale. In other words, the U.S. has to pay more for the same products it was before buying at lower prices. That's where the good news starts to become bad news. The prices of imported products are increasing, and prices of exported products are also declining. Jeffrey Snider said that, literally, the U.S. export prices are crashing. According to the latest report, the export prices fell by 2.64% month over month. Something everyone misses here is that the prices of imports are increasing, and exports have decreased since June 2022. That's a consistent decline the U.S. economy has been bearing for over 7 months, but no one is making any noise. Listen to what Jeffrey Snider said about that.
Today's CPI for December was the third straight, which the markets took as confirming the supply shock case, the disinflation side of the predictable eventual supply shock. Today, we got the University of Michigan survey on consumers. I've talked about that before. Consumers are getting the same sense that everyone else's consumer price pressures are falling. Just briefly, the University of Michigan's one-year expectation for consumer prices fell to 4.0% from, I believe, 4.4 in December. This is the January number. That's the lowest since April 2021, so consumers can see what's happening. The 5-year consumer price expectation, University of Michigan, stuck at 3%, where it's been really since the beginning here. Consumers never expected that consumer prices would get out of control and stay out of control. They always expected that they would go up and come down, as I've said before. That matches market pricing and tips other parts of the treasury market, which have all said whatever happens in the short run with consumer prices, it was going to be transitory. Yesterday's December CPI continued to make that case. Today, I think even more important than the CPI in one respect, the BLS, the same folks who put together the CPI, they published their import and export price indexes. So import prices rose 0.42% month over month, which was up 3.5% year over year. That's up a little bit from last month in the year over year, obviously 0.42% month over month, largely due to rising natural gas prices, not really an increase in demand. And really, the one that we want to focus on here is U.S. export prices. U.S. export prices, they crashed. They collapsed by 2.64% month over month. So that was just December from November. And export prices have been down consistently, as have import prices, since June. So in the global trade arena, especially where it intersects with the United States and U.S. demand, prices have been falling pretty steadily, especially export prices, and import prices up until this month, or December. Prices have been falling since June. There we see this again. A sharp response in price pressures based on a macroeconomic circumstance that has nothing to do with the Fed. And the fact that export prices from the United States are falling at such a sustained and heavy rate, they're actually down 9.2% since June. But it's not just about the U.S. That's what we're saying. Export prices, goods that are being sold, goods that are made here and then sold around the rest of the world.
But what does that tell us? Here's a little reminder to like the video if you are loving it. And if you don't want to miss videos about the evolving economics and the financial order, subscribe to our channel. Let's continue now. Here, it becomes quite clear why the prices of products are declining in the U.S. It's because the international market does not want products that hint toward diminishing demands not only in the U.S. alone but worldwide. The agricultural and non-agricultural products have neither high demands in the U.S. nor in any other countries. That's why prices are going down. However, it should be noted that demands have not been wiped away, rather, they are decreasing. If demands were zero, markets would crash. That's what the market is fearing these days. Now, you might think that it is good that prices are going down. At least households are getting some relief, right? Well, that's right, but this relief has a brutal cost for the U.S. economy. That cost is the market breakdown, which can default the U.S. economy entirely. If the demands in the U.S. were declining, but the world was still absorbing the products, the consumer prices in the U.S. would not decline. But, coincidentally, in every country, demands are returning to normal from a highly supersaturated level. But this is not limited only to the U.S. We know China is one of the biggest exporters, or perhaps the biggest, in the world. Therefore, does not price decline and diminishing demands hurt it too? Well, the answer is yes. According to the latest data, it is revealed that China's exports have dropped by 9.9% year over year. In other words, in 2022, China exported 9.9% less than it did in 2021. Note that in 2021, the world was still going through COVID-19 and lockdowns, but still, China earned a lot from exports. However, in 2022, when everything came back to normal, the demands were decreasing, and so were the exports. The decline of 9.9% for China is terrible, which shows how vulnerable the entire world system has become. Every country is seeing diminishing demands, creating a crack in the international trade system. Chinese exports to the U.S. were down by 19.5% in December year over year. That's just unbelievable. Even Chinese exports to Europe plummeted by 17.5%, which shows that the markets are now midway to getting crashed. How would the markets work when there are no demands? Prices will decline badly and dramatically, and factories will have to stop producing products. Today, everyone is worried about high inflation but should know that a drastic price decline will soon come. And this price decline will not be good news, rather, a time bomb for the market crash. Listen to what Jeffrey Snider said about that.
A lot of what the U.S. exports is agriculture, and agricultural prices did fall from the U.S. export part of the index. They were down 2.4% month over month in December. But it wasn't just agricultural prices. It was the prices of everything, especially non-agricultural prices, which fell 2.7% month over month in December. So major drops in export prices, which tell us what? That demand in the U.S., we already knew that was weak, but its demand around the rest of the world is coincidentally also falling off too, which isn't going to be Fed rate hikes. That's got to be something else. So we have U.S. CPI, consumer prices going down since June, which is a reflection of U.S. demand softening, which we see in import prices except for December's natural gas. But it's also weakening demand around the rest of the world. Export prices falling, as are trade numbers, and as well as trade projections, which is the stuff we're going to get into. Let's do the trade numbers first. So U.S. exports, demand weak from the rest of the world. You're going to turn to China. Because last night or early this morning, China time, the Chinese reported, the General Administration of Customs there, reported their own trade statistics. Not prices, this time actual values of trade into and out of China. So exports out of China, so their proxy measure of global demand, fell 9.9% year over year. Again, this is by value, not by volume. They don't give us the volume numbers on an aggregate basis. For certain products they do, but 9.9% by value. And that means by volume, that's a pretty big drop, which of course I know everybody, that's just lockdowns, whatever the case may be. But you didn't see these kinds of value drops back when the ports were restricted and Shanghai was closed earlier this year. This is something different. And that something different extends, of course, to the United States. Exports to the U.S. were down 19.5% year over year in December. And that follows a 25% drop in November. Something big changed with regard to at least China's perspective of U.S. demand. U.S. demand seems to have fallen off a cliff. And again, these are value numbers. But it's not just the U.S. It's not just the U.S. Chinese exports to Europe tumbled by 17.5%. But I know, that's the ECB, rate hikes there. Not at all, because Chinese imports fell by 7.5% year over year, again by value. Imports from Europe. China is one of Europe's biggest trade customers, especially Germany. Imports from Europe down 13.5%.
What do you think about where the declining prices and demands will lead us now? High inflation hurts households, but markets still work in such an atmosphere. However, when demands are dropped, markets inevitably fall because no one wants to buy the products. Comment right below in the comment section, what do you think will happen? Will we see a market crash in 2023? Do you want to watch more videos like this one? If yes, please like and share the video and subscribe to our channel for more videos on the latest economics and financial news. Until the next video, stay tuned.